Hello, and welcome to the Orthodontic Products Podcast. I'm your host, Alison Werner. On today's episode, we're discussing one of the biggest financial concerns orthodontists have when considering a DSO or OSO partnership, whether they can rebuild or even grow their annual income after the transaction closes. While many deals provide significant upfront payouts and future equity opportunities, doctors still want to understand what post-transition compensation really looks like and how larger organizations work to improve practice profitability over time. In this conversation, we explore how compensation structures typically change after a partnership, the operational strategies DSOs and OSOs use to drive growth, and the financial questions orthodontists should be asking before making a decision. Back with us to talk about this is Ty Ramsey, a mergers and acquisitions advisor with Professional Transition Strategies. The firm has completed more than 600 transactions nationwide, representing more than $1 billion in deal flow. During our discussion, Ramsey explains how organizations evaluate post-transition earning potential, what operational changes can influence a doctor's income after partnering, and why understanding the full financial picture extends beyond salary alone. Here's our conversation. Ty, thank you for joining me again. I really appreciate it.
Yeah, really happy to be here. Had a great time last time and looking forward to chatting again.
Yeah. Okay. So many orthodontists worry that after partnering with the DSO or OSO that they won't earn the same annual income they were making beforehand. How common is that concern in your conversations with doctors?
Well, I would say if you're just looking at go for W-2 income,
Mm-hmm.
yes, that can be the case. It depends. They could end up making more. It depends on the structure. There are multiple buckets that we look at, and then we do a 5-year estimated wealth accumulation based on amount of cash at close, time
Mm-hmm.
value of money, their go forward comp, their equity, and how that appreciates, and even the rent on their building if they own the building, because
Okay.
that can be another lever that they didn't think of. Is we get in and negotiate for a triple net lease with
Mm-hmm.
a long-term multi-million, sometimes multi-billion tenant. Instead of having Bob's Burgers as the building you own, you now own a building that McDonald's is the tenant. So
Mm-hmm.
that can be, but at any rate, there's 4 buckets that
Mm-hmm.
we consider. One of them is cash and close. The other one is the go forward comp.
Mm-hmm.
The other one is the equity in the group and what that is eventually going to be worth. Those are really the 3 buckets, and then kind of a 3A is the rent and a long term kind of lease if they own the building. So, while there can be, I would say the normal go forward comp rate for an orthodontist is
Mm-hmm.
going to be anywhere from um, 1,500 to maybe 1,400 to 2,000 per diem.
Mm-hmm.
Can also be a percentage of collections, but
Mm-hmm.
um, the way they need to view it is if they were to step back from the business and just wanted to own it
Yeah.
and just take the profit that it spun off every year,
Mm-hmm.
what would they pay an associate? And they're becoming an associate, but really they're not. They're
Okay.
becoming a partner of this group and working together. And then they'll be paid a fair doctor wage moving forward. But like I said, we look at all those different factors
Mm-hmm.
and come up with a wealth creation plan for them and we always compare it against status quo.
Okay. Well, I'm kind of curious when doctors do say, like, I want to get back to what I was making before the deal, what are they actually referring to? Are they talking about salary? Are they talking about distributions or lifestyle or just overall wealth creation?
Yeah, I'd say overall wealth creation, but not all doctors, pick just the highest offer. We
Mhm.
return, on a good practice, we'll return normally 5, 6, 7, sometimes 8, 9 offers to choose from, and they don't always pick the highest offer. It's
Mhm.
all about cultural fit too.
Mm,
And I call it a mental return on investment.
yeah.
There's a lot of my clients that have told me, "Hey, I never thought about this, but once I cemented an exit plan,
Mhm.
an eventual exit plan, whether it be 5 years, 10 years down the road, they say so much stress just came off of it
Mm,
because now, as a private practitioner, I mean, God forbid something happens and they can't practice tomorrow.
yeah.
The value of their practice just plummets,
Mm-hmm.
and the value of their biggest asset just plummets.
Yeah.
What we do is allow them to take some chips off the table and diversify their biggest asset.
Mm,
So it's not just about getting back to what you were earning before. We take
mm-hmm.
many different things into consideration. But yes, in general, if you're looking at just W-2 moving forward,
Mm-hmm.
there an orthodontist, I would say a going rate is going to be anywhere from 1,500 to 2,000 per diem. But
Mm-hmm.
keep in mind they're getting a nice lump sum up front. We do
Right.
a full analysis, time value of money versus their seller discretionary earnings. So we're always comparing against status quo. So here's what you're doing now. Here's what this looks like
Mm-hmm.
moving forward.
Yeah.
That there's no surprises moving
Mm.
forward. The last thing we want is for them to feel like it's a reverse mortgage.
Oh, okay.
There have been cases where, we've told clients, hey, we don't think this is good for you.
Yeah.
Yeah, we'd love to do the deal for you, but as
Mm-hmm.
your advisor, it's my job to tell you, if I think a deal's good or bad, and I
Mm-hmm.
don't think this is a great deal for you. And that's
Yeah.
happened before.
Yeah. What can you give an example of what would a bad deal look like in terms of, your compensation down the road?
Mhm. Yeah, I would say a bad deal looks like for any craps players out there, you're betting all on the come. You're betting a lot on future events.
Mm-hmm.
So, very little cash at close. And you've got tons and tons of equity
Mm-hmm.
awarded with a
Mm.
bunch of ifs, ands, and buts.
Okay.
And so you might be taking that hit on go forward comp, and the whole deal is dependent on the equity and the appreciation of the equity.
Mm-hmm.
That's to me, that's the worst kind of deal where you just have a huge amount of equity
Yeah.
that's awarded to you and not much cash.
Mm. Okay. Okay. You've talked a little bit about this, but I kind of would like to have you go a little bit deeper. When a doctor transitions into that DSO OSO partnership, how does their compensation structure typically change?
Mhm. Yeah, so they'll go from, just a bunch of, they normally legally run a bunch of tax treatments through, cars, maybe paying family members who help out, things
Mm,
like that. All that stuff, they might buy, a cone beam, or they might pay a consultant
mhm,
50,000 for the year and be able to write that off. So
mhm,
all that stuff goes back to their EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And all DSOs and OSOs base their offers on a multiple of EBITDA.
mhm,
So their comp structure, all those one time type of expenses or capital expenses, all
mhm.
those the capital expenses will continue going
Yeah.
forward, but won't count against them in
Mhm.
most cases. Or
Okay.
there are certain cases where they do a what we call a joint venture type of deal. So if
Mhm,
they spent 100,000 on a cone beam and had a 60-40 joint venture partnership, they might pay 40,000 and the group pays 60.
okay.
So, but they're just their pure comp, they're gonna be normally on a per diem
Mhm,
or a percentage of collections. But
mhm,
also, we normally negotiate some kind of growth bonuses in there or
mhm,
even profit share moving forward. If it's a joint venture situation where they still retain a portion of their practice as ownership,
mhm.
the more their practice grows, the more their profit grows, the more their income grows.
Okay.
So, it's two different structures, two different ways to grow your income
Mhm.
post partnership.
Okay. Within the practice, what are some of the biggest operational changes that can directly impact a doctor's income after these partnerships?
Yeah, just these the DSOs and OSOs will do a full analysis of the practice
Mhm.
with us prior to making an offer, and if a practice is really maxed out and they don't
Mhm.
see a lot of room for growth,
Mhm.
they might not make an offer. I mean, but
Oh, okay.
a lot of times they have a whole bunch of levers they can pull.
Mhm.
Schedule optimization,
Mhm.
helping with staffing, materials are, going to be 30% cheaper.
Mhm.
There are a lot of, maybe they add a retainer program that
Mhm.
hadn't been implemented before, but they have, 100 scenarios where it's, been very profitable.
Mhm.
So they might recommend that.
Right.
Might not make the doctor do that, but recommend it. Hey, it's to both of our benefit if we
Mhm.
add a retainer program
Mhm.
here on the front end. So they have all kinds of just imagine a consultant advising some stuff. It's like having a consultant with live data all the time with
Mhm.
50, 100, 200 locations of data that
Right.
they're always pulling from. So they just have all these different levers they can pull
Mhm.
to make the practice more profitable. And the
Mhm.
average growth first year of a practice joining a DSO or OSO is about 9%.
Okay.
Um, and that's average across all the different kinds of groups.
Mhm.
In orthodontics, I would say, at least the clients um, I've had multiple clients grow over 20% the first
Okay.
year.
Okay. What what have you seen what do you think is the key driver of that success for those practices, those 20%?
It's just a matter, like I said, of pulling all those levers, just
Mhm.
following partnering with the group,
Mhm.
while completely keeping their autonomy.
Okay.
People need to remember we screen out tons and tons of groups. The
Mhm.
groups that I call activist groups that
Mhm.
come in, and if the doctor joins, they're just part of a spreadsheet.
Mhm.
They use their materials, they follow a script, they do
Yeah.
everything by playbook cookie cutter. And those are the groups that have turnover doctors every 18 months that you hear
Mhm.
about. The groups we work with, the majority of are doctor led, doctor owned,
Mhm.
doctor founded.
Mhm.
And doctor's name stays on the door, staff stays the same.
Mhm.
They're the product. They're investing in the doctor as the product, and they want
Mhm.
that product to carry on as long as they can. So the last thing they want to do is come in, make a bunch of changes. They do take the back office off the doctor's plate, the stuff
Right.
they don't enjoy doing anyway,
Right.
accounting, payroll, that kind of thing. But that's probably one of the biggest things when the doctor just has time to just do orthodontics
Mhm.
and not dedicate it to a bunch of back office stuff. They can
Okay.
easily grow along with best
Wow.
practices that they have basically a buffet plan of best practices
Mhm.
that have worked at other practices
Yeah.
and that they can choose from. So it's just any number of ways they can grow.
Yeah, I don't think we've really emphasized before the fact that, with removing that back office responsibility from the doctor's plate, there is gonna be more time to see patients. So, yeah.
Absolutely.
Yeah. What in your opinion separates partnerships where doctors successfully regain or exceed their prior income from those where doctors end up disappointed financially?
I would say, in most cases, having good broker representation.
Mm.
That's my job is to make sure that they're one of the biggest decisions they'll ever make. It's going to be a good one, and to give
Mhm.
them all the information that we can
Right.
so that they can make an educated decision.
Mm.
Just like if God forbid, had to go to some big court case you were involved in,
Mhm.
you probably wouldn't have a great outcome if you just went in and represented yourself
Right.
versus hiring an attorney. Well,
Right.
and I joke with orthodontists, I wouldn't, I could, maybe not legally, but technically I could watch a YouTube video of how to treat a class two div two and
Uh-huh.
then try to treat it. my outcome is going to be very different from yours because
Right.
that's what you do.
Yeah.
Just like conversely with us, my outcome is going to be very different than yours on a practice transition. There's
Mhm.
a great example of it was an oral surgery practice that we partnered in December, and they had gone to market,
Yeah.
and we do all specialties, by the way,
Mhm.
but they had gone to market on their own, and they let me know this after we had successfully partnered them, but
Mhm.
um, they had gone to market on their own, gotten a couple offers, rejected them,
Mhm.
hired me to take them to market. We got 9 offers. The one they went with ended up being over 50% better than what they got on their own.
Okay.
So
Yeah.
I would say, you need great representation to do that.
Mhm. Okay. For orthodontists who are considering a partnership, what financial questions should they be asking to better understand their post-transition earning potential?
hmm Yeah, that's something that there's 100 different things that go into that, and I
Mhm.
would just suggest that they get a free valuation done with us.
Mhm.
It's a complete valuation on the practice underwritten by a dental CPA.
Mhm.
Helps uncover any blind spots. It could mean millions of dollars to them in the future. We
Mhm.
compare their supplies spend, their payroll, their marketing, their
Mhm.
rent versus industry averages, take all kinds of demographics into consideration.
Mhm.
And then we present them with this 15 to 20 page document that's a complete valuation on their practice. And we
Yeah.
use that to market their practice if they decide to go to market. But there's
Mhm.
no obligation. The
Mhm.
free valuation is theirs to keep.
Yeah. Well, but I'm just also curious, like, even if they're just preparing and they want to walk into
Mhm.
that conversation with
Yeah.
you,
Mhm.
what should they be thinking about in
Yeah.
terms of those financial questions so that they
Yeah.
can feel prepared coming in to sit down with you even?
Yeah, they need to step back and take a look in the mirror and saying, "Hey, what have we where are my weak spots?" And a lot of
Mhm.
times they don't know. So they don't know the questions to ask. We
Yeah.
help with that, but it's gonna, maybe their payroll's really high. Maybe their rent's really high. Maybe
Mhm.
they can start doing same day starts and
Mhm.
drastically increase revenue.
Mhm.
Maybe it's just a whole number of things.
Yeah.
But they always want to make sure that they have their expenses and their payroll under control and
Mhm.
for a start. And
Yeah.
they also want to make sure they have a great culture. That's very important as
Mm.
well. These groups can see through a bad culture and
Mm.
they won't make investments. They want like-minded doctors that have great cultures in their office.
Yeah. Okay. Well, Ty, thank you for being with me again. I really appreciate it.
hmm Great.
Thank you.
Thanks for having me. I really enjoyed chatting about it.
Great. Thank you.
As always, thank you for joining us. Be sure to subscribe to the Orthodontic Products Podcast to keep up with the latest episodes, and be sure to check out orthodonticproductsonline.com to keep up with the latest industry news. Until next time, take care.